It's coming, and Powell warned it would happen. I'm your host, Steven Van Metre, and thanks for joining me today. As Fed Chair Powell has been pressured by Wall Street, President Biden, and Congress to get a handle on inflation, and he's been warning them and anyone would listen that perhaps that's not the problem. And now the data is starting to show that Powell's about to be right. And he warned us all. Let's pick this story up when we head over to the Wall Street Journal, who headlines that American workers could be about to get a lot more productive. If the pandemic eases this year, the changes it prompted might pay big dividends. And that sounds like good news for the labor force. The Labor Department on Thursday reported that productivity, as measured by how much the average worker produces in a typical hour, grew at a whopping 6.6% annual rate in the fourth quarter from the previous quarter, a big gain, but one that came on top of a substantial 5% decline in the third quarter. For the whole 2021, productivity rose 1.9%, and that was less than 2020's 2.4% productivity gain and less than a 2% logged in the pre-pandemic year of 2019. The thing is, the U.S. could really use a productivity boost right now. The more a worker can produce in an hour, the lower the labor costs for production go. And that is a key point in this article, which mostly gets this whole story right. But let's keep going, because the conclusion is pretty interesting about how Powell's about to be right. When productivity growth is high, businesses can sell more, pay workers more, and increase profits while leaving prices unchanged. At a time when investors are worried that rising wages will pressure profit margins and that persistent inflation will lead to the Federal Reserve to slam on the brakes on the economy, stronger productivity gains would be more than welcome. And better productivity might be on the way. One reason is that the pandemic precipitated changes in the way people work that, if the pandemic eases this year, could pay big dividends. The ability to work from home when that is a better option and head into the office when it isn't, or to meet virtually, sometimes in person others, could make people far more efficient. The productivity path from the online menus and ordering system many restaurants have put in place might not really arrive until the restaurant business has fully recovered. But perhaps there's another reason. Well, when people are on the job longer, they tend to learn it. And the more they learn, the faster they get. And that's a big issue here, because the employers said they didn't have the kind of workers they wanted. So they hired anybody that would take the job. And now the more time these workers are spending, well, looks like the more productivity they're putting out. Let's continue this story. As moreover, with labor hard to obtain and demand strong, businesses have some of the strongest incentive in years to figure out ways to be more productive. Given alternatives of losing sales or seeing labor costs take an even bigger bite of profits, here's guessing many of them will come up with ways to be more efficient than they never would have when wages were stagnant and economic growth was mediocre. And let's head over to the Fred database, because what we want to look at is what this relationship is between productivity, unit labor costs, and inflation. Because Powell's been warning that inflation was transitory, and he finally had to bow to the pressures of Wall Street, the Biden administration, and Congress, who now believe that inflation isn't transitory, that it's permanent. But what if he's about to be right, and this data actually proves it? Well, let's take a look, because what you see here is non-farm business sector, the labor productivity of output per hour for all employed persons, that's in blue, and in red is the consumer price index. And what you see is a periods where labor productivity is low and then moves higher. Well, all of a sudden you'll notice that inflation turns into disinflation. And we can see that repeatedly. Here's a point. I've circled a handful of them, and there's tons of them in here where you see the productivity goes up and inflation goes down. And this kind of makes sense, because when you think about what an employee is doing, they're outputting more per hour of work than they were. Well, as the article suggested, that leads to disinflation. It actually leads to less wage growth, which we'll talk about in a moment. But check this out, where we're at right now with the data, as we can see productivity is hiding behind the CPI line in red, but it's shooting higher, which suggests that we are at or near a peak in the CPI and about to see disinflation, which again is what Powell warned would happen. Now let's take a look at unit labor costs, because there's an interesting relationship when we overlay that with the consumer price index. And notably, when consumer price index starts to go down, you'll notice that unit labor costs go down with it. that they peak at the same time. Now, you might be wondering how it is that that actually could occur. Well, think about this. If you are an employer and you're struggling to find people to do a job, you start to raise your wages to attract people. But when you attract new hires, do you get the kind of person that is turnkey, that you can slot right into the job and can do it at maximum efficiency? Well, of course not. Now, sometimes you get someone who has some experience, but when the labor market is tight, as the Fed is suggesting, well, you get what you get. And so let's say you hire 3 people to do one job. Well, you know that one of them is probably going to quit in the near-term future, leaving you with 2. And out of those 2, one of them is really going to grasp the job and is going to be your star. And the other, well, you might end up laying off or putting them in a different position, doing something different. And so what happens is unit labor costs start to go down because you don't need as many employees to do the job. And of course, you don't have to pay those that are doing the job as much because you already did when they showed up. And so check this out. As we go back to this chart, you'll notice that when the two tend to peak together, they go down together. And what this suggests is if indeed we're seeing a peak here, and we are right now, where CPI is up and unit labor costs are rolling over and headed down, that perhaps the big raises are going to be a thing of the past, and we might see higher unemployment claims, and we should see the CPI peak and turn over, because you'll notice it's very consistent when the two peak what happens next. And there's a reason some of this happens, because when we take a look at real hourly compensation, now this is in blue, and what real hourly compensation is, think of real and change your word out to inflation adjusted. So when you look at inflation compared to hourly wages, well, you get an interesting picture that perhaps even at these higher wages, that workers cannot afford higher prices. And when you think about that, it tells you what happens is they end up rejecting them because they can't buy as many goods and services as they did before. And well, that puts greater pressure on inventories to rise, and then that leads to a downtrend in the economy. And let's take a look here, because what do we see is that when real hourly compensation in blue is down here at the bottom in negative territory, and I circled a few of them, that usually you see a matching peak or a soon-to-be peaking consumer price index. And here you see one, here's another one that I didn't circle, here's one where the CPI kind of went up a little higher and then came down, and you'll see here's one, and look what's happening now, that we see that real hourly compensation for all employed people is negative, meaning they cannot afford these higher prices, suggesting that inflation will indeed get rejected as demand declines. And so let's look at one more here, because then the question then becomes well, what does that mean for interest rates? Because the broad view still means that interest rates go up. Well, what happens if we now know that inflation is likely to soon peak and head lower? Well, what does that mean for the bond market? Well, let's take a look, because here we're overlaying 30-year treasury yields, and you can see that where you see peaks generally in yields and the CPI, well, it leads to yields going down. You see, here's a case, here's one, here's another one, even though it was a shorter one, it still went down and then continued lower. Here's one where it really fell off, and here's 2 more cases where it went down. And now what's notable about the bond market is yields aren't really backing up due to this really big move in the consumer price index. But what it suggests is where this peaks, well, that interest rates are likely to peak as well, which suggests that the probability is that interest rates are more likely to go down than up, and that means bond prices are likely to make a resurgence. And so what was Powell warning about here in his message is that inflation would indeed turn out to be transitory. And the problem we face now is that he has been pressured to withdraw all the monetary stimulus and start to move into a tightening cycle. And what happens when you start to see disinflation during a tightening cycle? Well, do you know what actually then happens? Well, you get a recession, and if you're lucky. And if you're not lucky, you get a financial crisis. And if you're worried about how your portfolio might endure another great financial crisis, well, you shouldn't. Be sure to check out Portfolio Shield. There's a link in the corner and in the description below. You'll be glad you did. But now let's try to see if there's any evidence to suggest that Powell is right and the economy is slowing and that wages aren't high enough, and there is a rejection of these higher prices. Let's continue on with the story. We'll head back to the Wall Street Journal with headlines that U.S. consumer spending fell 0.6% in December amid inflation and Omicron. Of course, Omicron getting the blame for everything, as the Commerce Department's gauge of inflation rose 5.8% from a year earlier. Meanwhile, prices continue to climb as the Commerce Department Personal Consumption Expenditures Index measure of core inflation, which excludes volatile food and energy costs, of course, as we know, both are going up, and is closely watched by the Fed, rose 4.9% from a year earlier. That marked the fastest year-over-year increase since September 1983. And Friday's report showed household incomes rose 0.3% in December, but note, less than what the price of goods did, but didn't increase. But the increase didn't keep pace with rising inflation. Overall inflation as measured by the PCE index rose 0.4% for the month and 5.8% from the year earlier, proving that wages are not growing fast enough. But we already knew that. There are broad signs that consumers pulled back in January. Spending at restaurants, airlines, and travel bookings have cooled since late November, according to card transaction data from research firm Factus, and has been in decline this month at home supply stores and wholesale clubs. Without any surprise, that should be happening. And economists largely forecast growth will be weak in the first quarter of this year, but they predict consumer spending will rebound once the current Omicron wave of COVID-19 infections taper off. And that is the story we keep hearing, that this is all about COVID-19. It's all about Omicron, that as soon as that goes away, spending will go up. But the data continues to show that consumers and workers don't have the money to afford higher prices. And of course, ultimately, that will lead to lower prices, as the data is already suggesting. And perhaps there's even further evidence to show that employers may not need all the employees they have, and they're starting to let a few of them go here and there. And we take a look at this week's unemployment claims, and you see they cooled down to 238,000, just slightly above what you would want at the 200,000 range at a really strong economy. But it's still telling you, why are we seeing people get laid off at a time when there's almost 11 million job openings? Well, perhaps because as productivity rises, well, employers are getting rid of the least productive employees. But there may be some other evidence on top of that, as we see here from Zero Hedge, who headlines December U.S. factory orders tumble the most since April 2020 COVID crisis. And then we see what in the data that new orders fell 0.4%. Now, that's not a huge event and doesn't occur a whole lot, and the year-over-year change remains high, but it's perhaps just a signal that if orders are going down, what does that mean for inventories? Well, they might be going up. Let's take a look at the ISM manufacturing PMI data to see if we can get any information out of their January report. We see that new orders, the growth rate slowed down a little bit. Inventories are growing at a slightly slower pace, and that's at the manufacturer level. But note that customer inventories who report that they're too low, well, fewer of them are reporting that that's a problem. They still remain low, but not quite as many are having an issue there. Prices paid are rising, and the backlog of orders is slowing. So what we're seeing, at least in the manufacturing sector here, is there still is a bit of a backlog, but it's not as persistent as before, and that perhaps that they will start working through this. And what the question then becomes is demand falling? But perhaps what we need to do is go look at the services sector, where it becomes a little more obvious that things are slowing down, as the services PMI fell and is growing at a slower rate than it did last month. But look at inventories here on the services sector. They're contracting at a slower rate and telling us that perhaps the inventories may be getting to a point where they're where they need to be. And of course, with all those orders still in the system, that means inventories are likely to rise. Prices paid are increasing at a slower rate. Perhaps that is affecting some inventory levels as price goes up. Consumers reject them, and we'll be watching that relationship. We know the backlog of orders is growing at a slower pace, but here, then this may be due to a stronger U.S. dollar, is export orders are contracting from a rapid pace. They went from 61.5, which is a brisk pace, to a contraction, and that is not normal. In fact, we're seeing inventory sentiment, which was previously and is still too low, but fewer firms now are saying that they have an inventory problem, and the overall pulse from the ISM is the economy is growing at a slower pace, and that ultimately leads to disinflation. So as Powell's been warning, inflation will be transitory, but he's been pressured into withdrawing stimulus and heading into a tightening cycle. Of course, today's non-farm payroll report certainly suggests that as well, which we'll cover in the next episode. But nevertheless, what he's been warning is that a recession is coming, and now you can see in the data that it is. I'm your host, Steve Van Metre. Thanks for watching. I appreciate you being a fan, and we'll see you soon. Bye now. The content of this video is provides education and informational. It's not intended to provide investment advice. This video is not to be construed as recognition or solicitation to buy or sell a security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre or personal capacity. Business expresses video that do not affect the view of Atlas Advising or Steven Van Metre Financial.